We got Shreevar Kheruka, the MD at Borosil Limited, joining in on the show right now. Shreevar, hi, morning. Great to be speaking with you. Shreevar, tell me about the commercial production which is currently underway at your Rajasthan flask facility. How's the ramp up progressing? When will the third line come on stream?
Yeah, well, thanks for having me. We just commenced commercial production of two of our three lines at the end of last month, that's end of June. And it's been a long time coming. We've suffered in the last year because of lack of availability of that product portfolio. These are insulated steel flasks, which are used for, drinking water, hot and cold. The third line, as you mentioned, would be coming up in the second quarter. So once all three lines are up and running, we should be producing more than 1 million bottles per line, so roughly 3.5 million bottles at this facility, and we should, be back on track as far as that product category is concerned.
And is this with regard to Hydra, which is the vacuum insulated stainless steel? Weren't there problems with regard to supply there?
That's right. So exactly, there was BIS regulations or QCO, a quality control order, was placed on imports of this product a while ago. And in order to comply with this, we started manufacturing. Actually, it was a boon in the long run that we manufacture this product in India. And that's what we did. But of course, in the short run, there were supply chain disruptions, as a result of which we lost some revenue and market share in this product category. But now that our production is up and running, I think we'll be rapidly back in the market and back with our original market share very, very quickly.
Yeah, back to the original market share. How much does that immediately add to your top line for FY27? Because this was a drag. For how long was this a drag? What was the impact on FY26? Could you give us a sense of what this does immediately, incrementally to FY27 revenue?
Well, I'll answer that in two ways. As far as last year is concerned, of this category, our sales went down by about 30%. We had, of course, inventory when the order came in, the QCO. We had enough inventory to last for a few months, but you can't obviously stock up for more than a year. For this category, we lost about 25 to 30% revenue last year. As far as, so obviously the first track or the first goal is to make up for that and regrow, that 25-30% loss. However, just a caveat here on production ramping up. As we know, any plant, it does take time to ramp up production, to get the quality and the quantity at a desired level. It's a lot of skill involved. So I'm hesitant to give any kind of numbers for this particular year, except to say that, we have a very well experienced team. And I do expect in the next 3 to 6 months, this capacity to be at 100% utilization. And therefore, we should make up the losses from last year.
Sorry, Shreevar, I was just reading up. And my understanding is 100 crore was the revenue lost for FY26. Is that number broadly right?
Yeah, it's in the ballpark.
Right. And you recover all of that in FY27, pretty much?
Yeah, like I said just now, recovering all of that in FY27 depends on the ramp up, how quick we can ramp up the production. It's hard to put a prediction on it. God willing, everything going well, I think we could recover that entire amount, but I wouldn't want to commit it at this stage, given that it's just started the plant.
This is a better margin product for you as well, and the margins took a bit of a hit as a result of this. Am I right in the way I'm kind of addressing this?
Yeah, well, you see, margins one is a gross margin and one is net margin. We had the gross margin; it's about average with the rest of the product portfolio we have. So it's not a higher margin product versus others. However, on a net margin perspective, we have a lot of fixed costs. So in a sense, when we lost that sale last year, we had reverse operating leverage, which impacted our overall margin. Obviously, all the costs, below gross margin. Whether it's manpower, whether it's advertising, we couldn't really reduce any of that, even though the sales of this category were down. So that's the reason we believe that the margins will, move back up to what they were before. And of course, having production in-house gives us massive leverage with product development, new product introductions. And that itself is positive in the longer run for margins. And you can add more value to your customers, which then results in higher margins.
Right. So, since it all, Shreevar, does depend on Capex, let's talk about exactly that. Give me an exact count on where things stand with the Bharuch glass facility, the Jaipur furnace expansion, etc. And of course, your new opalware and borosilicate glassware unit too.
So look, we've been on a fairly aggressive capex spree over the last couple of years, maybe the last 3 years, and given the market conditions are improving, obviously we had this blip of the West Asia crisis in the last quarter, which was substantial, and obviously in the short run that will depress margins with higher prices. But when we plan for capex, we're always looking at the medium term to long term. So our capex plan has been, going forward unabated. I think this year we'll end up spending between 150 to 200 crores of capex again. Some of that is the Bharuch plant that you mentioned. Some of that is expansion of our Jaipur borosilicate plant, which has already been approved by our board. And then, of course, the Hydra itself, even though 3 lines we have already committed, most likely we'll have to add to this, this production. So capex would be in that, 150 to 200, maybe even cross 200 crores this year. And we do see a lot of runway for growth, both from a product portfolio as well as from a capex perspective. So we will not be shy in taking the calls that are needed to grow the business.
Okay. Talk to us also about, therefore, all the backward integration that you're working on. The guidance is that you'll do 20% plus in terms of EBITDA margins at some point of time. How quickly do you get there? Give us some color on this, especially given that you've now booted up even the business which was shut down last year, or rather had slowed down last year.
Yeah, look, as far as our original targets were that we would hit that number in the year 26, 27 or 27, 28, I probably have to delay that by a year. So maybe in 28, 29 is where I do believe that we should be closer to that number. And it's not rocket science, frankly. It's just the number or the margin will move up just because the manufacturing percentage of our product mix will increase. As the manufacturing percentage increases, we get the manufacturing margin in-house as well. So that's the reason why we believe that our EBITDA margin is going to rise, and it has been. It was just that it got set back last year when we lost this, this rather, reasonable chunk of sale because of supply chain issues.
And furnace capacity, how's the ramp up playing out on that side of things? Because that will also likely mean that you're able to kind of ramp up capacity and sell more.
So furnace capacity, opal glass is different and borosilicate is different. On the opal glass side, I think we're doing reasonably well in terms of achieving almost entire capacity utilization. As far as borosilicate glass is concerned, while we're selling, frankly, the margins are not as where we would like them to be because there's a lot of dumping of this product from China. We have applied for anti-dumping duty. We do have to sell the capacity because of, the furnace is continuous and you can't keep inventory. So we sell it at very low prices in some cases, which we would hope to, arrest once, we have some kind of ruling on the anti-dumping, which is specific, again, for the import of pressed borosilicate glass from China, which is hurting us today.
And the anti-dumping duty as well. You were expecting that to come in maybe a couple of quarters from now, if I'm not wrong. Is that kind of timeline still in place? Do you believe that it will come out in the very near term in terms of, is there a possibility of that?
Frankly, that's really not in our control because,
Yes.
there's a process we can only apply, and that's very much with the government of India. There's a proper mechanism through the DGTR, Director General Trade Remedies, and they take it up and, they have a very, very strong and established process which they follow. So it's hard to give you any kind of timelines on that, but we do hope, our merits are strong, we believe, of our matter, and we do hope that we'll have a positive kind of feedback from them.
Okay, Shreevar, great chatting you today. Thank you so much for your time.